Welcome to Money, Money, Money. I'm Sunera Abdi and with me is Surbhi Upadhyay. And if you're wondering what the two of us are doing here, well, I'll be heading for a sabbatical soon and we'll be entrusting money, money, money to Surbhi's trusted and very capable hands. So Surbhi, thanks very much for taking over the reins. But you know, we can't make it that easy for you. You have to actually have your trial by fire, and which is to answer a really simple question.
I'm already tense. I'm already tense.
No, to go through the hallowed gates, you have to answer it, and which is, what does money mean to you?
That's actually a simple one. For me, it means freedom, it means liberation, it means being allowed to pursue my dreams, to do what I need to do, to enjoy the things I want to enjoy, and to have the sense of security and comfort about the future. It pretty much encapsulates everything.
Well, that's a good answer, but you know, I was just kidding, right? And we never intended to make it difficult for you anyway. But it's not all fun and games this week. We're almost at the end of the financial year and haven't yet seen the full gamut of tax-free bonds hit the market. Are companies going to allow them to lapse? What should retail investors be looking for in the current scenario? Are tax-free bonds even attractive anymore? That's the question we'll be asking GAURAV MASHRUWALA, a certified financial planner and the author of Yogic Wealth. GAURAV, thanks very much for joining us this week. First up, congratulations on your new book. How's it going?
So doing well. So CNBC is the publisher,
yes.
And the English version is out, and we're expecting Gujarati and Hindi to be in about a month and a half's time. So keeping fingers crossed.
All right. I know it's something that I'm going to be looking forward to reading in my sabbatical. But get back to the topic on hand, tax-free bonds. Now, taxable bond funds score about 100 basis points higher returns when compared to tax-free bonds, right? What is my incentive then to invest in a tax-free bond?
So it depends on which tax bracket do you fall in. If you are in a higher tax bracket, then it makes a lot of sense to pick up these tax-free bonds. If you are in tax bracket which is nil or even 10 or 20%, then you may really want to take that call as to, is this really making sense for you? Because the differential interest returns in your hand post-tax may not be substantial. So look at what is return going to be in your hand, number one. Number two, these bonds have long maturity. So do you want to hold on to it for that long time, and do you have something, some kind of goals to be achieved that you're picking it up? So while they sound good, it depends on several other factors before you just go and apply for it.
So let me ask you this, the rate of interest itself. These bonds, I believe, are back to the benchmark 10-year government security yield, right? A couple of notches below that. How would the interest rates then compare? Are these attractive rates for an investor to look at?
So as I said, those government security bonds, GSECs, may not be that easily available or accessible to a retail investor. Also, retail investor is not very active on wholesale debt market. So while there is this provision that whenever RBI does, there is certain portion reserved, but we have rarely seen any participation. Plus the process of applying and whatever. Vis-a-vis this, because there are these so-called IPOs, that's the way it comes, there are road shows, there are agents approaching. So for a retail participant, this could be a better and an easier way than looking at government security. So it's more from participation perspective, because GSEC again are taxable. This is tax free, but it's more from applying and doing it. It's more easier.
No, also let me turn it another way around. The GSEC is at say 7.98%, right? So this is say a few basis points lower, 7 quarters, 7.5. Is that rate by itself attractive, or is it attractive only when pegged to inflation?
Both of them will lose to inflation over a longer period of time. It's just that the interest from GSEC will be taxable. So if you're looking at central government securities that comes up, that will be taxable. This is tax free. So if it's 7.9 today, GSEC, and if you're in even 20% bracket, you're going to earn much lesser return post-tax vis-a-vis a tax-free bond, which is approximately yielding around 7.25, depending on whether you're going cumulative, half yearly, whatever. To that extent, if you're looking at picking up a long maturity product, then this bond will work out better.
Okay, so tell me one thing. Do you think investors actually need to reset their expectations with respect to tax-free bonds? And when you say that it's attractive, do you mean only a fresh issue is attractive, or is buying in the secondary market also attractive despite the liquidity constraints that may be there?
Good question. So here, let's look at pros and cons. Number one, in secondary market deals are happening, but they aren't that easy. So unless you are looking at investing slightly bigger amount and you have your broker, because the dealing and the purchase has to happen through stock exchange. So you have somebody who's willing to kind of put up a trade and wait for 3-4 days. My general experience is within 4 to 5 days you will get a deal. To that extent, you may get bonds which have completed 3 years, which means you will get your money back in 7 years' time with almost similar kind of returns. So to that extent, shorter maturity, if you're looking at an earlier liquidity, this is better. On the other hand, if you want consistency of income and you want surety, which means you want a long-term paper, then so based on when do you want this money back, what kind of liquidity, you can try either for the older issues which were there, which are listed, with a bit of effort you'll get it, or apply for new one.
So based on what you said, would you say that these bonds are taking care of the reinvestment risk and the reinvestment concerns of the portfolio for people who are willing to be invested in these bonds for such a long duration, 10 to 15 years?
Yes, I mean reinvestment risk is for you and against you, in the sense that if you're looking at long term and you don't want to take that chance, then put it in here, because you're saying for 10 or 15 years, I'm assured of 7.25% return. On the other hand, what happens if 5-6 years down the line, we have bonds coming up with a higher yield? Then you are stuck, because then if you were to go and sell these on the secondary market, you may fetch a lesser price. So there is a risk either way. Now it depends when do you require this money in terms of maturity. If you're looking at 10 or 15 years, you're sure you want peace of mind, go ahead and pick it up. If not, then if you're going to be trading or something, then don't do that. Probably I'm just digressing, but debt funds could work out to a better option, because then they will play on duration or whatever. But let's keep the debt funds issue outside. It's just that take your call when you will require this money.
Okay, fair enough. But tell me one thing now, barring HNIs who can invest unlimited amounts, do you actually see much appetite for tax-free bonds at the fag end of the financial year? And are you expecting again for the budget to announce a fresh set of tax-free bonds for the next year?
So I'll be happy if they announce, because whether people pick it up or not, at least to an investor, that one more option and avenue is available. Retail participation, they haven't been getting that many bonds when they have been applying. To that extent, they will. Also, the word tax-free, and it's good that you're doing this show, people blindly apply without considering that is it really post-tax returns beneficial to me or not. So whenever the word tax-free comes, we will have people applying, and till 31st March, if you have issues coming up, they'll keep applying. But ideally, what we discussed earlier, look at what will be your post-tax return, and also look at when do you require this money. Those two should be the parameter, and not because some road show is happening or some so-called IPO or whatever is happening.
But let me go back to the original point. As you were saying, that these bonds make really good sense for those who are at the highest tax bracket range. But even for them, would these compete well with other debt products or other saving schemes like PPF, etc.? How does the comparison stack up? Why should one do tax-free bonds?
So when it comes to PPF, let's look at two things. One is PPF is an account. These are bonds. So when you invest in bond, once the rate of interest is known to you, the technical word coupon yield, that coupon rate, then that remains constant. In an account, so PPF is an account, government can tweak the rate. And hence your returns can go down, can go up. I mean, it started with 4.68% somewhere in 1969. PPF rate went up to 12%. Now we are somewhere around 8.7, and we are hearing that it can go down. So that's one. Second is, as far as PPF is concerned, the maturity is 15 years after you invest, and then you can do in blocks of 5 years. Here you have an option of 10 and 15 years, number two. In terms of liquidity, PPF you can borrow, and after some time you can withdraw. Here the liquidity is by investing in stock market. PPF also has a restriction, you can do only 1.5 lakhs in a year. Here there is no upper cap. So a lot of pros and cons, and both should be looked into. Investor may want to pick up both, put 1.5 lakh in PPF and yet do that, or look at the requirement and then pick it up. So it's not one in lieu of other, it's that what is important.
What suits you. Yeah. And the cap is so much higher in a tax-free bond anyway.
Exactly.
Okay. So now deposit rates may be trending lower, but what about a lot of these senior citizen schemes are still offering very, very attractive rates, right? 8.5%, 9%, 9.5%. Does tax-free bond make any sense for a retired person? Does it have any place in their portfolio?
A wealthy retired person, brilliant candidate for lot many things. But yeah, definitely. So if you're an HNI or ultra HNI with lots of money, or even inheritance, and more so senior citizens, or huge retirement corpus that has come to you. See, once you retire, what you're looking at is stability and security of your money. So government bonds, security, or I mean, all the institutions are kind of that way secured, and stable. You're sure of that. So to that extent, HNI, ultra HNI, retired people may want to consider this as a regular income, keeping in mind that part of their portfolio should be in equity as well, so that that portfolio generates returns which are higher than inflation. You're losing to inflation here, but you have money in your hand which is not taxable if you're falling in higher tax bracket.
Okay, on that note, we'll take a quick break, but when we come back, we'll be talking about the debt portfolio and how it should be structured in tough times like these. Stay tuned.